What's up everybody, it's Prashant here. Welcome to my YouTube channel and thank you for joining me today. I took a bit of an unplanned break over the past week from my regular posting schedule when I spent some quality time with my family over Thanksgiving break, took care of some car troubles, got a COVID booster shot, got knocked on my butt from the side effects, but I'm finally happy to be back in front of the camera recording a video for all of you. I wish that I'd come back from my break to a stock market in the green, a continuing reopening of the world, and to tell you that Christmas is going to be awesome and that you should be seeing a Santa rally in the market. But I woke up Friday to news of a new COVID variant called Omicron first detected in South Africa. Soon after that, the UK imposed travel bans from people from 7 South African countries, soon followed after by the EU as well as the US. Israel has even gone so far as to ban all travelers from around the world, and a lot of other countries have since instituted similar travel bans. Obviously, this is horrible news for all of us trying to get over the pandemic. We definitely remember the destruction that the Delta variant caused, first in India and then here in the US as well as all across the world. And we definitely do not want to see another dangerous variant doing its rounds around the globe. Already, cases have been detected in many countries around the world, including Canada, the UK, Netherlands, Italy, Hong Kong, as well as Australia, among many others. All this news of new lockdowns has been absolutely horrible for financial markets all across the world. In fact, the Dow had its worst day for the year on Friday, 11/26, dropping 900 points or 2.53%. The S&P 500 fell 2.27% and the Nasdaq fell 2.23%. Guys, before we continue with this video, I want to take a second to ask you to smash the like button for the YouTube algorithm and also go ahead and subscribe to this channel. That being said, let's get back to it. Yesterday on Monday, the markets rallied and stocks recovered a bit. This is probably because of all the buy the dippers coming in and buying the sale. Now I wondered if this was it. Maybe markets fell on Friday for good reason, but maybe the dip was over, maybe the pain was gone, and we'll be back on track as before. But today, Tuesday, 11:30, the story changed again. The Dow fell another 650 points today. Obviously, investors are still worried about the Omicron variant. There are many more cases being discovered in countries all around the world, and we just don't know how bad things will be. There are some preliminary reports that the cases of disease because of the Omicron variant are actually much milder than what we've seen before, but we are still weeks away from knowing that for sure. And the one thing that the stock market absolutely hates is uncertainty. To top this, Daddy Powell came out today and said two very important things, neither of which the market liked. The first thing that he said is that he thinks that the Fed should stop calling this inflation that we're experiencing transitory. Why? Well, here's the rationale. When the Fed says transitory, most people understand it to mean temporary, and it makes sense. Merriam-Webster dictionary defines transitory as of brief duration. So it makes sense that when you say transitory, people will think temporary. But it is scary and confusing to consider that the high inflation that we are currently experiencing is sustaining. We've already seen several months of 5 to 6% inflation year over year. And this is pretty confusing to the layman like you and me. On the other hand, Jerome Powell is saying that when the Fed uses the term transitory inflation, what they actually mean is that this period of higher inflation will not have a permanent effect on the long-term inflation target of the US. And now they're saying that perhaps the Fed needs to stop using the term transitory and be more clear with the public as to what they mean. You would think that they would decide to do this from the get-go, but maybe they're thinking about it a little bit more and realizing that everybody is not an economist, and maybe it'll be better to explain what they mean in more clearer terms. The second thing that Jerome Powell said is that they could consider wrapping up their bond purchases program much earlier than anticipated. In the November meeting, the Fed had announced that they will be slowing down their bond purchases at a rate of $15 billion a month. This would mean that they would have wrapped up their bond purchase program by the end of June of 2022. But now he's saying that they could wrap up a little bit faster and be done as early as spring of 2022, after which they could start increasing interest rates that much sooner. You see what's happening here. Earlier in the year, we had indications that interest rates would not be raised till late into 2023. Now, slowly but surely, that date is creeping closer. First, it came to early 2023, then late 2022, and now in the spring or summer of 2022. So what's happening here? Is the Fed abandoning everybody? No, of course not. This was always the plan. You see, when we have an economic crisis, the Fed will typically open the money taps and spend a bunch of money to get people employed again and get the economy start running again. And then as the economy ramps up and gets a little bit hot, you turn down the taps, so you slow everything down again, and then you return to business as usual state of affairs. Of course, at this time, things are starting to run pretty hot, and the Fed has to step in to pump the brakes and cool the party down a little bit. In an ideal world, the Fed would inject exactly the correct amount of money, the economy would heat up exactly the desired amount, and the Fed would turn off the money taps at the exact correct moment to bring inflation back to the 2% long-term goal of the Fed. But of course, this is the real world. It's not the ideal world. The real world is messy and things tend to move in spurts and starts, and there is not much to do about it except to adapt your plan to your circumstances, and this is exactly what the Fed is doing right now. Anyway, what comes next? Well, here's what I think. The markets have been very frothy for a while now. Stocks have been running super hot for about a year and a half, cryptocurrencies too. And the same thing can be said for real estate. When all assets are doing so well, are so hot and so high, it makes me wonder if this can keep going. Obviously, this tells you that I'm scared at this time. If this new Omicron variant becomes dominant around the world and forces fresh lockdowns, it would be very, very bad for stock markets around the world. I wanted to know if this was just me or if the markets in general were thinking along the same lines. Lucky for us, there are a couple of numeric indicators we can take a look at. The one I want to talk about in today's video is called VIX, which is a volatility index which was invented and is maintained by the Chicago Board Operations Exchange, or CBOE. This is a real-time indicator that shows the expectation of volatility in the market over the next 30 days. The math behind the index is pretty complex and I do not want to get into it in this video. Here's what we do want to know though. Typically, this index moves inversely to the S&P 500. So on days that the S&P 500 does really well, the VIX index goes down. And on days that the S&P 500 does poorly, the VIX index goes up. And there are two main numbers that we need to remember. The first one is 20. When the value of VIX is below 20, it means that there is little fear in the market and this is business as usual. However, when the number goes above 30, this means that there is increased volatility in the market due to uncertainty, and this translates to much more fear in the market. Let's look at the VIX index over the last 5 years. The last time the index spiked well over 30 was on March 20th, 2020 to 66. Obviously, this is when the market dropped off a cliff. The next time the VIX spiked over 30 was in January of 2021, this year. Again, this was soon after the Delta variant started spreading and we were seeing record high cases shortly after the holidays last year. This again caused a sell-off in the market. Today, the VIX is around 27, once again inching closer to that 30 number. We have seen several days of increased volatility and trading, and there is clearly market fears due to the Omicron variant. So here's what I'm doing. I'm hoarding cash. Typically, I'm not a proponent of hoarding cash. I like to keep my money invested in the stock market. As a long-term investor, I believe that no matter what happens in the short term, over the long term, I'll be okay. But personally, right in this moment, I'm holding on to cash. Now, that does not mean that I'm selling any of my investments. I have not sold a single stock this entire year. In fact, I'm still buying every week through my 401k. But I'm not putting any extra cash into the market. I've already maxed out my Roth IRA for the year. I was able to get to that 6K number back in September, and I was able to buy stocks when stocks were a little bit lower back then. But since then, I have not put any more cash into the market. Maybe a few $100 here and there, but nothing that actually makes a significant difference. Right now, I'm just happy to hold on to my cash for a few weeks. Typically in December, we see hedge funds selling some of their holdings to lock in some of their profits as demanded by their investors before the end of the year. And with the uncertainty in the market and maybe the Omicron variant is a variant of concern, I can see a little bit sharper decline than is usual. My hope is that after the first of the year, I can use the cash position that I've built up and put it into a tax-advantaged Roth IRA account for 2022 and use that money to buy the dip if there is any. Now, if I'm wrong and there is no dip and the Omicron variant turns out to not be such a big concern and the stock markets are doing just fine, I'll just go ahead and buy the S&P 500 anyway. So that's all I have for you guys in today's video. I hope you guys enjoyed today's video and learned something about this new Omicron variant and what I think is going to happen next. Remember, this is not financial advice and you should do your own due diligence and make your investing decisions based on what you think is best for your personal finance position. If you enjoyed this video, please go ahead and smash the like button and subscribe to my channel and click the bell icon to be notified instantly when I post a new video. I promise I'll be getting back to my regular posting schedule starting this week, and I hope I will see you back on this channel. Thank you so much for watching and see you next time.